So welcome back to part two of our session on Nexus and revenue sourcing. And in this part of the rules, we're going to look at more categories of revenue. So this part is a bit more technical and more detailed, but hopefully the principles that we've learned in part one about the reliable method, about categories of income, hopefully you'll see that theme runs through each of the different categories of revenue as we discuss them. So let me just share my screen. So the next category of revenue is components. And I have to say this was quite a challenging part of the rules for us to design. So you might remember that in the blueprint, the original scope for Amount A was only intended to cover automated digital services and consumer-facing business. It never included business-to-business services or business-to-business transactions like sales of components. However, under the extended design of Amount A and the extended scope of Amount A, B2B transactions, including sales of components, have come back into scope. And what makes sourcing components very difficult is that the M&E that makes and sells the component often will have no visibility over where that component ends up. So the component could be something like a semiconductor that's designed and that could be included in a range of different electronic devices, whether that be mobile phones, laptops, or tablets, or cars even. And the M&E who's making the component will sell it to a third party, often will have no information about what that third party intends to do with the semiconductor. The third party mightn't even be a finished goods manufacturer. The third party might be a component manufacturer, say, that is incorporating the semiconductor into maybe a motherboard. And then they sell that motherboard onto another M&E that's incorporating the motherboard into a laptop. And so the component M&E can be very removed from where the component ends up in the distribution chain. So that was one of the big challenges that we had to deal with. But following discussion at the TFDE, it was settled that the source rule for revenue from components should be the place of delivery of the finished good that incorporates the component to the final customer. So again, it's a similar rule to the finished goods rule. We're looking at the jurisdiction where the finished good is sold to the customer. And we know from speaking with business that there are very few component companies that can track their components to that extent, and they often won't have that information. So although within the rules we've included indicators for sourcing this revenue, we know that in practical terms, it will be very difficult for M&Es to use and to apply and to have access to those indicators. So just to run through them, the indicators for components to identify the place of delivery of the finished good, incorporating the component to the final customer, are very similar to what we've seen for finished goods. They're the delivery address of the finished good to the final customer, or the retail storefront that sells the finished good, or another reliable indicator. However, given how remote the component M&E is from the final customer, within this rule, we include an allocation key. And it's expected that in many cases, M&Es that are selling components will have to use the allocation key to source their revenue. And that's why the allocation keys are so important. They help us to ensure that in all cases, revenue can be sourced. Because if revenue cannot be sourced, that means Amount A can't be allocated. So that's why these allocation keys are so important throughout the rules. So as I said, the allocation key for revenue sourcing for components is the global allocation key. The global allocation key operates by allocating revenue to jurisdictions in proportion to their final consumption expenditure. And final consumption expenditure, just as a reminder, is an amount that's typically published by jurisdictions in their national accounts. And it's a measure of spending by households and government within that jurisdiction. So that's the allocation key that we use for the sale of components. So on to services. And as I mentioned previously, the services category is a very large category. And as you can see here, it includes quite a number of subcategories. And you'll see, that the two services that are marked in blue, those are two subcategories that were also included in the blueprint when the scope of Amount A was limited to automated digital services and to consumer-facing business. So you see, this is another area where we've done quite a bit of work on revenue sourcing. So the broad kind of principles that underpin the whole section on services is that what we've tried to do within the rules is to source the revenue for service to the place of use of the services. And in some cases, that's really obvious. You'll see that as we go through the rules, particularly where we have rules like location-specific service, transport services, the place of use is quite obvious. But in other cases, it's more difficult to identify the place of use given the nature of the service. So for example, merger and acquisitions like an advisory service in respect of merger, a global merger and acquisition, it's quite difficult to figure out where is that service actually used. Like it could be used in the headquarter jurisdiction of the M&E that's doing the acquiring, or it could be in the headquarter jurisdiction of the M&E that's the target jurisdiction, or maybe it's every jurisdiction where the target has a physical presence. But that's what makes the service piece quite difficult, is that the place of use isn't always apparent. So again, this is an area where allocation keys are used more frequently for revenue sourcing. But by splitting each of the different services out, we've tried to pull out the types of services that we think are easier to source and to give indicators that are more sensible and practical to apply to those types of services. So the very first category of services are location-specific services. And these are services that we think are correctly sourced to the place that they're performed because they are so connected to that jurisdiction. And we've two types of location-specific services. So first of all, we've services that are connected to tangible property. So these are services that are very related to some kind of tangible property. And here we're talking about services like repairs of tangible property, maintenance in respect of tangible property, leasing of tangible property. And the source rule for services connected to tangible property is the place of performance of the service. And the place of performance of the service, to identify that, we've given indicators. And in this case, we think the place of performance should be the location of the tangible property at the time the service is performed. We've also allowed M&Es to use another reliable indicator. So if they have other information that they would want to use rather than the location of the tangible property that identifies the place where the service was performed, they can do that too. Again, this is a place where we wouldn't expect that M&Es would need to resort to an allocation key. So only the default rule applies, or only the default allocation key applies, which permits the revenue to be sourced only in very limited circumstances using an allocation key. And the allocation key in those cases is the global allocation key. But this is really an area where you're to expect to see M&Es using their indicators and knowing where the service was performed and therefore where the service was used. The second category of location-specific services are services that are performed at the location of the customer. So these are services where the customer needs to be physically present for the performance. So we've things here like medical services, or concerts, big sporting events. Those would all be location-specific services. And again, similar to services connected to tangible property, the source rule for those services is that revenue should be sourced to the place of performance of the service. And for the place of performance of the service, we've given some indicators, the main indicator being the location of the customer at the time the service is performed. But of course, we allow M&Es to also use another reliable indicator if they've other information that would accurately and reliably identify the place where the service was performed. Again, this is an area where we would expect M&Es to use indicators and have reliable indicators available for the purposes of sourcing. So although an allocation key is provided, it's default allocation key only that applies in very limited circumstances. So it should only apply in those types of cases where there's been a fail entirely by the M&E to try to apply the revenue sourcing rules and to try to use indicators. So both advertising and intermediation services were included in the blueprint in October 2020. And the rules here, you'll be pleased to know, remain as they were published within the blueprint. And these are two types of services that really were the whole debate on the challenges of the digitalization of the economy and taxing the digitalization of the economy. These are the types of services that really gave rise to a lot of those concerns and challenges. Of course, for something like advertising services, here we're usually talking about the big online advertisers. So the big social media companies like Facebook or the online search services like Google, those businesses were selling ads from, say, a small number of hubs globally, but they were selling that advertising to flash up on mobile phones and on laptops and computers all over the world. And you'll know this, that a number of the jurisdictions where their population was being targeted for advertising, they weren't receiving any tax revenues from those large businesses. And so in response to that, a number of jurisdictions began to design digital services taxes that would have given them rights to tax the revenue associated with the advertising that was being targeted to their populations. So this really is where is where the whole debate began. And these rules are kind of core and have been around for a long time and reflect as well a lot of what we see in the digital services taxes. So advertising and revenues from advertising under the rules for Amount A are sourced to the location of the viewer. And that's important. So they're not sourced under the traditional rules. That type of revenue would be sourced to the location of the person who's selling the advertising. So where their business is. So it's not that location. The second thing, the other debate that we have had on advertising services is that the revenue isn't sourced either to the person that's paying for the advertising. Here we really see that the advertising revenue wouldn't be generated without the viewers. And so it's the viewers that we use as the source. And that reflects what happens in the digital services taxes. So all the time for advertising services, we're looking for the location of the viewer. And for that purpose, we've included indicators that would allow you to identify the location of the viewer. And those indicators are things like the geolocation of the device of a viewer of an ad, the IP address of their device, or their user profile information. And of course, the M&E can use another reliable indicator also to identify the location of the viewer. In most cases for online advertising, we would expect those businesses to understand and to know where the viewers of the ads are. That is their business. But we do provide a default allocation key, which would enable revenue from online advertising to be sourced in the absence of indicators. So really only in cases where the M&E has totally failed to apply the revenue sourcing rules would the default allocation key apply. And the allocation key, again, in that case, is the global allocation key, which allocates revenue to jurisdictions in proportion to final consumption expenditure. For intermediation services, we're talking about online platforms that bring together buyers and sellers of services. So the big examples are the ones that you know of intermediation services are things like Airbnb, where the platform allows people to rent property one to another, or Uber is an example of an intermediation services, where taxi services are bought and sold. And sometimes Amazon operates as an online marketplace where buyers and sellers of different goods are brought together. And when we think about where the market is for the intermediation service, remember the fee for the intermediation service is independent and separate to the fee for what's being paid for the underlying good or service. And so for the intermediation service, we think the true market is the location of the buyer of the good or service on the platform and the seller of the good or service on the platform. So it's a 50-50 rule, so it works slightly differently to the other rules. And we think that's a better reflection of what the intermediation service is doing, rather than selecting one or the other market. It really is about bringing together those two places. We do, of course, have an exception. Sometimes these intermediation platforms are buying and selling, or bringing customers together in respect of location-specific services. So location-specific services are things like hotel services or taxi services that are very tied to the jurisdiction where they're performed. So for those cases where the intermediation service is being provided in respect of a location-specific service, the route is slightly different. The revenue is still shared 50-50, and it's 50% to the location of the buyer and 50% to the location where the service is performed, because of the importance of that jurisdiction. And that's a jurisdiction that we see as a market in those instances. Again, the indicators are not dissimilar to what we see for advertising. So we're looking to the geolocation of the buyer and the seller, or the IP address of the buyer or the seller, or their user profile information. And of course, then for the place of performance of the service, we're looking to the place of performance of the service. And of course, the M&E always has the option to use another reliable indicator. Again, this is a place, given the nature of the service, this is a place within the rules where we would expect the M&Es to have access to good information about where about the location of the buyer and the seller, or the place of performance of the service. So we only make an allocation key available in very limited circumstances, such as where there's been kind of a revenue sourcing fail on the part of the M&E, and really the allocation key there should only be applied to enable revenues to be sourced in those very limited circumstances. The allocation key is the global allocation key, so it allocates revenue in proportion to the final consumption expenditure of each jurisdiction. So the approach for transport services is a bit different to what we have in the rest of the rules. It's a far more formulaic approach. And the M&Es are not required to use indicators to source revenue. Instead, very specific allocation keys have been developed specifically to deal with the transport industry. And this was based on kind of discussions with members of the transport industry in terms of what was possible and what wasn't possible. And rather than using quite generic allocation keys for cases where these businesses didn't think they'd have access to indicators, we instead designed these bespoke allocation keys for different types of transport services. And when you look at the rules, you'll see that the rules split services out into air and non-air transport. And that's just to do with some particular arrangements that apply to airlines. But for the purposes of explaining the rules, really the difference is in the operation of the rules are between how passenger transport services is sourced and cargo transport revenue is sourced. So looking first to passenger transport services, the revenue is always sourced to the destination of the transport service. And the destination rule was preferred really to limit complexity, because if you think about passenger transport services, the passenger should always end up where it started. So rather than having rules that require the M&E to split the revenue in two and give half to the origin and half to the destination, if each leg of the journey is treated as a separate service, then each stop is a destination. And of course, the origin becomes the final destination. So we think it's a simpler way to apply the rule, and it shouldn't give rise to distortive outcomes. So as I said, this is an area in the rules where the M&Es don't need to use indicators to source revenue. Instead, we've given a passenger transport allocation key. And the passenger transport allocation key is designed to allocate all revenue received from selling passenger transport services to each of the destinations that the M&E serves. And that's in proportion to the passengers carried. So next, for cargo transport services, the rule is a bit different. The source here goes 50-50, 50% to the place of origin and 50% to the place of destination. So that's different to what we've done for passenger services, but there's a reason for that. Because the passenger will almost always go back to their place of origin. The cargo doesn't. The cargo normally goes in one direction only. And if we had used a destination only rule, what would have happened is that the rule would have favored importing jurisdictions over exporting jurisdictions, because importing jurisdictions would have received the vast majority of the revenue. And so for cargo transport services, we couldn't use a destination only rule. So instead, we stuck with the 50-50 rule. So with 50% of the revenue being allocated to the place of origin and 50% to the place of destination. Again, the M&E doesn't need to use indicators for the purposes of sourcing revenue, and instead can go straight to the cargo transport allocation keys. And the cargo transport allocation keys are designed to allocate revenue, so allocate all cargo transport revenue to places of origin and places of destination in proportion to the amount, so usually the volume of cargo that's carried to and from those jurisdictions within a period. And finally, we have customer reward program revenue. And when we're talking about customer reward program revenue, we're talking about revenue like that's earned by airlines for operating things like frequent flyer programs. And it's a particular type of revenue. What makes it unusual is how the M&E generates the revenue. So it generates revenue from selling frequent flyer miles to third-party businesses. And then those third-party businesses, they award the points to their customers who also happen to be customers of the airline. Meanwhile, in the airline's books, they don't recognize the revenue when the points are sold to the third-party business. They only start to recognize that revenue as the points are redeemed by their frequent flyers. And so here, when you think about how the revenue is generated, in some way you can draw kind of parallels with advertising, in that it's not the payer that's allowing you to generate the revenue, it's actually your base of active members of your frequent flyer program. So that's where we source the revenue. We source the revenue to the location of the active members. And for that purpose, we have different indicators for identifying where those members are located. Things like user profile information is information you'd expect the airlines who run these programs to have, their billing address, They might have the international dialing code from their phone number, and all of those are included as indicators. And then the allocation works using the customer reward program allocation key, and that allocates the customer reward program revenue to each jurisdiction in proportion to the number of active members in those jurisdictions. So you'll be glad to know we're coming close to the end of services. But this last category is a very important category because these are all of the other services that we haven't so far captured in our rules that we've gone through. So we've split this category, or in the public consultation document that was issued that had the model rules, this category was split into two subcategories. So first of all, we had business to consumer services, and then second of all, business to business services. And the types of services that are left over here, say for consumer services, are mostly online services. So things like streaming services, gaming, software services that are sold online, all of these would be captured within this final catch-all category. And under the source rule, those services are all sourced to the location of the customer. And we have included indicators within the rule for identifying the location of the customer. And the indicators differ depending on whether or not the service is online or a non-online service. So for an online service, the indicators are the ones that we'd have seen previously, and you'll expect to see them here. Things like the user profile information of the customer, their billing address, or their geolocation. Remember, if these are sold online, the M&E should have access to these pieces of information, the IP address, or another reliable indicator. Then for the non-online service, and I suppose when we're talking about non-online services, we're talking probably about advisory services that are given to customers. So things that aren't delivered online. So there, the indicators that are included within the rules are the billing address of the customer, or their international dialing code from the phone number, or another reliable indicator. So all the time here, we're trying to source to the location of the customer, because that's the best reflection of where the market is. In most cases, we'd expect that the M&E would have access and good access to indicators to source their revenue, but for circumstances where they don't, when they've taken reliable steps to try to use indicators but haven't been able to, they can use the global allocation key to source the revenue. The second subcategory are B2B services. And this is another kind of big and important subcategory. So the types of services that are captured here are things like advisory services, so very large advisory services that are provided to very large businesses, things like management consulting services, kind of services that are given, advisory services on M&A transactions, all of that kind of stuff. But as well as captures all of the online services that are given to business. And a huge area here, it's something like cloud services. Most businesses will buy cloud services. So those are all captured within this rule. And the source for B2B services is the place of use. And it's important to note, and we mentioned this earlier on, that place of use, sometimes it's easy to identify for the service. So for example, if you have a management consulting business and it provides a service to one of its customers, which is to access a new market. So let's say it's a business that hasn't operated in China for the first time, and the management consultant offers a service to open up that market, which would involve analyzing the Chinese market, understanding the regulatory regimes that would apply to the business there, identifying the competition, identifying how consumers like to buy within that market. All of that analysis is so particular to that Chinese market that the place of use of the service would probably be China under this rule. But then there are other cases where the place of use just isn't as clear. So let's think again about that M&A service. So you have, let's say our management consultant again is providing advisory service in respect of a mergers and acquisitions transaction. And let's say they're advising the buyer under a global M&A transaction. Where is that service used? Is it used in the headquarters of the buyer, or is it used in the jurisdiction of the headquarters of the target business? Or you could see an argument as well that that service maybe is used in all of the jurisdictions where the target has a physical presence. So that's the problem, I think, with, or one of the issues that we have on the source route for B2B services that we don't really have anywhere else. Given the nature of the service, sometimes it's difficult to identify where the service is used. So it can be difficult for us to actually apply our source route. So this, again, is an area where we will expect to see M&Es use allocation keys for the purposes of sourcing. And you'll see that we have included indicators within the route for identifying the place of use for those cases where it's obvious. And those indicators include the place that's recorded in the contract as the place of use, or another reliable indicator. Then we have a special rule for smaller business customers. And for smaller business customers, we are permitting the M&E to use the billing address of the business customer to identify the place of use. That's subject to the proviso that if the M&E knows that the billing address isn't reflective of the place of use, it cannot use the billing address as an indicator. So that in that case, the indicator, the billing address indicator, isn't subject to the reliability threshold. It's a different threshold. So the only test is, do you know what's wrong? And then if you don't know what's wrong, you can treat it as a good indicator and it's deemed to be reliable. But that's only for smaller business customers, because we know for large business customers, sourcing to a single jurisdiction is probably not accurate. So for those cases, we have to come up with an alternative method for allocating the revenue, particularly for those cases where you have this issue of not being able to identify the place of use or not having enough information and reliable information to identify the place of use. The billing address doesn't feel right because it would source all the revenue to one jurisdiction. So for those cases, and this was an area where we had a lot of discussion again in the TFDE, it was decided that the headcount, the employee headcount of the business customer, the large business customer, is probably a good indication of where the service is used. So if you look at the employee headcount, that should be spread across most of the jurisdictions where, or all of the jurisdictions where the large business customer has a physical presence. The employees are probably as good a proxy as you'll get of use of the service. And the proposal was to allocate the revenue in proportion to that employee headcount. Of course, that would require the M&E to do two things. So first of all, to be able to identify the large business customers, and second of all, to be able to ask those large business customers for their employee headcount. So we had said in the draft that went to public consultation, the draft of the model rules, we had accepted that it wouldn't always be the case that the large business customer would be willing to hand over its headcount information to its service providers. So for those cases, we had an aggregated headcount allocation key. And that was an allocation key that was based on country by country reporting data and the headcount that had been recorded in the aggregated country by country reporting data that's publicly available. And that was an allocation key that was going to be made available in a compliance portal so that M&Es would be able to find an allocation key where they couldn't get the actual headcount of the large business customer. So this was an area where we received a lot of comments in the public consultation, in particular on things like businesses said it is going to be impossible for us to identify who's a large business customer and who's a smaller business customer. They also told us that it would be that to ask for employee headcount information would be problematic. Most businesses would consider that to be commercially sensitive information. So even asking from it from a commercial perspective would be difficult, and they would very rarely expect to receive it. So this is an area of the rules where we're doing a lot more work as a result of the comments we received on the public consultation. It seems to us that the place of use should remain the source, but for those cases where you have a large business customer that's probably using the service internationally, it's clear to us that we need to come up with some kind of allocation. It seems to us that headcount or some aggregated number for headcount that isn't specific to the customer might be a place where we end up. But this is an area to watch within the rules and where we will see some movement compared to what was published in the public consultation. And we're moving on now to intangible property, which is the last kind of large category that we have to go through. But we thought when we were designing the rules that it was important for us to have specific rules specific to intangible property. And these are mostly B2B transactions. And what we've tried to do within these rules is to ensure that the approach that we've taken is coherent with the rest of the rules, so that it shouldn't matter if a transaction is a transaction in respect of IP, if that really reflects kind of one of the other categories or one of that we have within the rules. So kind of the example that we give to explain what we're trying to do here is if you have a pharmaceutical. So within the pharma industry, that's an area where you'd see quite a few transactions for intangible property. So you might have a large pharmaceutical business that has the patented formula for, say, an active pharmaceutical ingredient. So the active pharmaceutical ingredient is the part of the drug that makes it work, right? So let's say our pharma makes and manufactures the active pharmaceutical ingredient, sells it to a third party, and then that third party makes the finished drug and sells the finished drug. There, the active pharmaceutical ingredient is like a component from the pharmaceuticals perspective. It should be sourcing that under the rules for the components. So to the place of delivery of the finished good, the drug, to the final customer. And then we were thinking, but it would be just as easy, or isn't it just the same kind of economically for the M&E if that transaction was structured kind of slightly differently, if they instead licensed the patented formula for the active pharmaceutical ingredient to the same third party. So that same third party could make the active pharmaceutical ingredient and incorporate it into the finished good and sell it. And what we're trying to do here is ensure that in those cases, we get the same result. So you'll see that in some respects, intangible property is a bit like a component, and we're always trying to source to the very end jurisdiction. So to where the product or the service that's made using that intangible property ends up. So we've split the rules into three subcategories. So first of all, we have IP related to finished goods, then we've IP related to copyrighted works, and then IP that supports a service. So first of all, IP related to finished goods. So here we're talking about IP that's used by the licensee or that's incorporated later into some kind of finished good. So we're talking about examples like the license of the patented formula to make the active pharmaceutical ingredient. And we're talking about things like, say, a license of a brand. You might have a lot of these luxury brands that would license their brand to be used on like sunglasses or clothes. Those would all be captured here. And our source rule says that you should source that revenue to the place of delivery of the finished goods to the final customer. And our indicators are very similar to the indicators that we see in the section dealing with components. So our indicators are things like the delivery address to the final customer, the retail storefront that's selling the finished good, or another reliable indicator. And I suppose while this is quite similar to components, in some ways, in practical terms, IP can be different because the licensor of the IP, the person that's generating the revenue from the IP, has some control, and within the contract often will put restrictions on where and how the IP may be used. And sometimes they will actually get reporting. So it can be different to components in that sometimes things like the royalty stream will be tied to the sales that are made by the licensee. And in that way, the M&E that's generating the revenue from the IP actually will have information and actually may have indicators to allow it to source the revenue. So similar to components in some ways, but then in other ways not. It really depends on the facts and circumstances. So for the cases where the M&E has the information about where the finished goods incorporating the IP, or the finished goods that are related to the IP, where they end up, it should use that information. However, we know that there will be cases where the IP is more component-like, and where the M&E that's licensing it simply isn't getting that information. And so for those cases, similar to components, we allow the M&E to use the global allocation key to source revenue from IP that's related to finished goods. And again, you'll see hopefully that when we go through the next two subcategories, the thinking is the same. So for IP related to copyrighted works, we're thinking here about things like movie distribution rights, or licenses of music, say a library of music. So like you might have a movie production company that licenses the right to distribute a movie to a cinema chain. The movie there is the copyrighted work. Or the music production company that licenses, say, a whole library of its music to a streaming service. The library of music there is the copyrighted work, and then we're licensing to the streaming service. So in all cases, what we're saying is that the source is the place of delivery of the copyrighted work to the final customer. So again, we're looking to the final customer. So for the movie that's licensed to the cinema distribution chain, the place of delivery to the final customer would be the cinema. And for the music that's licensed to the streaming service, the place of delivery to the final customer would be the location of that final customer. And the indicators here reflect the indicators that we've seen earlier in the rules, where there's kind of where we're trying to draw the parallel. So the retail storefront would get us to the cinema. The billing address, the geolocation, the IP address, that will all help us identify the location of the customer who's using the streaming service. And of course, the M&E can use another reliable indicator. Again, the amount of information the M&E that's licensing the IP has in relation to the final customer will very much depend on the nature of the IP license. So sometimes it will have indicators, but we also accept that it will often be the case that it won't. And for those cases where it's taken reasonable steps and it can't identify reliable indicators, it should source the revenue using the global allocation key, and the global allocation key will allocate that revenue in proportion to final consumption expenditure by each jurisdiction. And then finally, we have IP that supports a service. An IP that supports a service would include things like like say an entertainment group that makes cartoons and licenses kind of the copyrights and the logos and the brands like associated with one of their cartoon characters to, say, a theme park operator, and then the theme park operator develops a theme park based on that cartoon character. And our source rule says that the revenue should be sourced to the place of use of the service. So, and to get your indicator, you have to see what type of service it is and then go back to the services rule. So our theme park in the example that I gave would be a location-specific service. That's a service where the customer must be present to enjoy the benefit of the service. So our indicators for the location-specific service are the place of performance of the service, and that would be the location of the theme park. So in that case, we're trying to draw a parallel with what we're doing in our services, that the revenue should end up in the place of use of the service. Again, like all the other categories of the IP, whether or not the M&E has access to indicators will often depend on the terms of the licensing arrangement. For cases where it doesn't have access to reliable indicators, it uses the global allocation key to allocate the revenue, and the global allocation key will allocate that revenue in proportion to final consumption expenditure in each jurisdiction. So you'll be glad to know that we're on to our final categories And these are kind of our sweep up categories, our smaller categories where we thought we needed a specific rule. So first of all, real estate. So any revenue that's generated from real estate, as you'd expect, is sourced to the location of the real estate. Government grants, even though often government grants may not be recorded as revenue, and so may not need to be sourced for the purposes of the revenue sourcing rules. For cases where government grants are recorded as revenue, we have a rule that says they should be sourced to the jurisdiction that funds them. And then our very final category is this category that we mentioned up front, non-customer revenues. So this is revenue that's earned by an M&E that can't be said to be earned from a customer. So here we're thinking about things like interest income that's earned by a big business. And that interest income is earned from a bank, but the bank can't be described as the M&E's customer. So when we were trying to design a sourcing rule for that type of revenue, it was difficult for us to come up with something that was appropriate because there isn't a customer, so it's very hard to identify the market. So instead, for those types of rules, what we've said, for that type of income, what the rules require is that the revenue should be sourced in proportion to all other revenue that's earned by the M&E. So this would be the last category of revenue that we would see the M&E sourcing. It would source all of its other revenue under each of the different categories. And then when it looks at the proportion that's been allocated to each jurisdiction, if it has non-consumer revenues that are left over, that non-consumer revenue would be allocated in exactly the same proportions as all of the other revenue that has been earned and generated and sourced by the M&E. So you'll be pleased to know that's the end of today's presentation. I know it was a whistle-stop tour of the Nexus and revenue sourcing rules, but I hope that you find it helpful.